Welcome to Home Buying Made Easy, the podcast where we pull back the curtain on mortgages, real estate, and everything the big banks hope you never figure out. Michael Dendy is a licensed mortgage loan officer with Edge Home Finance, and I'm Rachel, co-host and producer of the show. Every episode, Michael and I break down the stuff that actually matters without the jargon. This show is designed for everyday people like you and I to learn the home buying process so you can buy smarter, save more, and stop leaving money on the table. Now let's dive into today's episode.
Welcome to another episode of Home Buying Made Easy. I am Michael and I have Rachel here with me as well. She is off to the side, ready to ask some questions.
I don't answer the questions.
Yes, I'm aware. I wore my handy dandy fishing shirt today. I'm going fishing.
Are you?
I am going fishing.
Yeah?
Yep.
Are you like going to the store and buying fish?
No. I'm actually going out on the boat, on my little boat. And
yeah.
I got a little 10-footer little boat.
Yeah.
And just puddle around the lake and go fishing.
Yeah.
I can't do that for a little while, though. I have mortgages to do.
Yeah, and we've got episodes, too.
Oh, yeah. Well. There's that.
So, yeah. But today's episode
is all about
me. I'm kidding. It's not.
All about mortgages.
It is about mortgages, not about Rachel.
It's not about Rachel.
Thank God. I think that would be not a great episode. Wouldn't perform well.
Well, it's definitely not going to help home buying made easy.
Maybe. They get to know me.
We'll keep that in mind as we make an episode eventually about Rachel.
I create the episode topics.
It's not going to happen.
Okay, but today's episode is about mortgage points. So can you kind of explain what mortgage points are?
Mortgage points.
Yeah.
Yes. So point one. That was just a joke.
Ha.
Yeah, I didn't even get two ha's. Just one ha.
Okay, mortgage points.
In Hawaii, they don't laugh very loud.
Yeah.
They just have a low ha.
Ha. Ha.
Yeah, that was my joke for the day. It was terrible.
Yeah, but you're not even wearing a Hawaii shirt, so.
I am wearing this is a Hawaii shirt.
No.
It's a fishing shirt, but it's from it's from Hawaii.
Okay, what are mortgage points and how do they work?
Wow, you just cut me off. Okay,
yes.
So mortgage points are, if today has an interest rate and that interest rate, this is the baseline for that interest rate, anything below that baseline, whatever that number is, anything below that, you have to purchase to go lower. Mm-hmm. If you are going higher, there's a lender credit. So it's kind of like a sliding scale. So the lower you go, the more you pay. The higher you go, the more credit you can get. But there's a thing called par. Par is the baseline. That's where the rate is at. So the problem with going online and looking at rates and saying, oh, such and such has this rate or such and such has that rate. You need to look at the fine print because in the fine print, a lot of times it says, yeah, you can get that rate. It looks really good, but you're paying for it. You're paying a point.
Yeah.
You're paying. So a point, to translate the numbers, what a point is, a point would be buying, like one point would be the loan amount. So if you have a $300,000 loan amount, 1 point is $3,000. That's how much it will cost.
Yeah.
Okay. But it's not like you buy a point, you get a point. So you buy you put $3,000 in and now you went from 6 to 5. That's not how it works.
Okay.
We'll kind of go over that in a little while and talk about, there's a break-even point and that kind of thing.
Yeah.
But the way it works is you can purchase or you can have seller credits to purchase to buy down the rate. You can also, let's say you don't have enough money for your closing costs. You can't do this with down payment money, but you can do it with closing costs. You can take your rate up. So if today's rate was 6, you can go up, let's say 6.5, and you're going to get a credit. That credit can be used towards closing costs. So like I said, it's a sliding scale. Okay. So buying points is when you take it from par, where the rate is today, and you're paying down to get a lower rate.
Yeah.
That's what points is.
Yeah. Okay. Let's talk about the break-even point that you were just talking about.
Okay. So a break-even point would be, let's say it's going to cost, we'll use the $3,000. If you're going to buy it down and you're doing a $300,000 house and you're buying it down $3,000, when you buy that down, if the interest rate comes down, let's say it comes down a 0.25. So you went from 6 to 5.75.
Yeah.
If that costs $3,000. So now you're at 5.75. You have a lower payment. So you don't have a 6% payment, you have a 5.75 payment, right?
Right.
And obviously I'm just making these interest rates up. Today's rates, you can reach out to us. We'll gladly walk you through what today's rates are. But if you're coming down a quarter point to 5.75, you might be saving $30 or $40. Well, $30 or $40 at $3,000 is going to take a while.
Yeah.
Like a lot of months.
Right.
So keep thinking of, like, if you want to do the math yourself, you can just take how much you're spending, divide it by the monthly savings, and that's how many months it's going to take you to pay it off. If you don't want to do the math, I'll do the math for you. Just reach out to us. That's what we do. So that's super important to know, so that there's a point where it does not make sense to buy down a rate.
Yeah.
Because there's not enough savings. Now, it compounds, like when you get into large loan amounts, like 700, 800,000, those kind of numbers, those are very quick to recoup costs because you're saving a lot more money per month by buying down a smaller amount.
Yeah.
So it really depends on where things are at with the market and what, mortgage rates are doing to determine, if it makes sense.
Yeah. Everybody's situation is different.
Every single one.
Yeah. Okay. So next question then, how long do you have to stay in the house for buying points to actually save you money versus just going along with the original par interest rate?
Well, that goes right back to what we just talked about, which is a break-even point. It depends on what you are defining. The home buyer, are defining as a break-even point. And the reason I say that is a lot of times people say, oh, I'm going to be in this house forever.
Yeah.
It's not going to happen. So now let's get realistic about, are you going to be there 3 years before you're ready to make a change? Let's say the house is a certain square footage and has a certain number of bedrooms, but then you start having your young family, you start having kids. Well, now you're getting squashed in space and you need something bigger.
Yeah.
Well, if you went and you bought down the rate, like there's a point where that was a loss if you're doing that in the first couple of years,
Yeah.
But let's say you have a plan. Hey, I'm going to stay in this house. I know I'm going to be in it for 5 years. After 5 years, I'm going to do this. And your break-even point that we were talking about is at 3 years. That might be a good thing,
Yeah.
And it really depends on affordability as well. Because some people, they don't, they're hoping rates are going to come down. There's no way, we don't have some kind of a magic toolbox that can tell you what the rates are going to be. But they're banking on the fact that, eventually rates are going to come down.
Yeah.
Little side note, a lot of people will say, and I've said it myself, marry the house and date the rate. That's not wise. The reason it's not wise is you want to get into a house that you can afford, not a house that you can afford later.
Yeah.
Because you're banking on a refinance that's coming because, rates are going to get better. Because we've been thinking that for a couple of years now. and rates have kind of settled out, and they're kind of even keel.
Yeah.
We're not getting huge drops. We're not getting massive increases. It's really kind of a neutral point right now. And if we stay there at that same level, you're not going to be able to refinance. And now you're stuck with that payment that you stretched yourself too much for already,
Yeah.
So you got to be super careful about that.
Yeah. Think smart. So next question is, are there scenarios where buying points makes more sense versus when it might just be a waste of money?
Yes. I would say I have investors a lot of times that will buy points because they're looking for a certain price point. If they're investing in a house and they know they're going to be leasing it out, they want to lease it for a certain amount and be able to have either a break-even point or a different break-even point, meaning the lease is going to cover the mortgage.
Right.
If they're trying to get to that number and they know they're going to have to buy it down to get to that number because they know they can lease it for X number of dollars, they'll use points like that. The other thing would be if I wouldn't recommend this for veterans necessarily many times because veterans or active duty, really, they're PCSing every 3 years. They're moving every 3 years. It's not going to really pay off, I don't think.
Yeah.
But there are some instances when rates seem to be it's weird. Everybody thinks that the rate sheet flows evenly down. So let's go back to our par that we were just talking about. If this is par and you drop down to a quarter point, the quarter point might be $3,000. But then if you go down 0.375, which is a little bit more, it's actually only $2,000. It's inverted.
Yeah.
It's kind of weird, but lenders will do that because lenders are banking on being able to play the market. The lenders on their end, they're buying and selling notes all the time. So they'll play the market in certain price brackets where a rate is a certain way, and they'll give a better rate at that number because they know they can sell it. It's an easier sell on the market.
Yeah.
It's called the secondary market.
Yeah.
So I would say there's times like that where it could benefit a first-time home buyer if the price points are in those ranges.
Yeah.
It'd have to be in that specific range that the lender's looking for.
Yeah. And it changed.
It changes multiple times per day.
Yeah.
And I could pull, you could do a mortgage application right now. I could pull all the numbers and I could wait 30 minutes and there'll be somebody else that they'll rank everybody, here's the best rate, the next rate, the next rate, the next rate. They'll rank them all. 30 minutes later, it'll be a different order.
Right.
They change all the time.
Yeah. So, okay. Very last question, closing question is right now. Okay. Let's say I have $5,000 at closing. Everything else is already paid for. Closing costs paid for. Down payments paid for. What should I do with that $5,000? Should I use it to pay down my rate, pay down the principal, or should I keep it more as reserves? What would you suggest in that scenario?
Who's answering? Michael, the mortgage loan officer, or Michael, the dad?
We'll go. Answer both ways.
Okay.
Yeah.
Michael, the loan officer.
Okay.
I would probably stick with the same answer, but I think that reserves are good.
Yeah.
And that's probably the best choice. Maybe if you put reserves in a high yield savings account or something, that's going to be a good choice because you're going to make more money there. Putting it on the mortgage, you're likely not going to get a huge return on $5,000. $5,000 is on the principal balance is going to give you, 20 or 30, maybe $30 a month, maybe not even that.
Wow.
$5,000 in points, it could put a dent in it.
Yeah.
You'll definitely get more than you would if you put it in against the principal.
Yeah.
But I personally think that it's probably good to have that reserve set aside. And even if you're putting it in something that you can't get a hold of easily, like maybe CDs, or there's a lot of choices. It depends on it. It depends on what vehicle, meaning what investment you want to make money on that money.
Yeah. Okay.
Does that make sense?
Yeah, it does. That was our last question.
All right. So if you have more questions about anything about mortgage related things, or if you just want to find out more about points or what it would cost for your specific scenario, whether you're purchasing or refinancing, feel free to reach out, give us a call, shoot us a text, send us an email. We'll see you next time.
That's a wrap on today's episode of Home Buying Made Easy. If you're ready to take your next step, our team is standing by. You can call or text us directly at 615-499-6335. You can also reach us at michael@dendyteam.com or check out the link in the show notes below. Whether you have one question or you're ready to go, we'll meet you right where you are. Thanks for joining us. From our team to you, let's make home buying easy.